Okay, we're going to look at the effects of taxation on your investments. Now, whenever you have an account that earns interest, then you are liable to pay tax on that interest because it's counted as income. So, how does it actually work? There's lots of different ways of doing it, and we're going to look at a couple of simplified ways. But if you just think of it, every time if you invest money and you have some money that you get paid into that from interest, that comes as an income, and any income is taxable, hence the word income tax. So let's have a look at a couple of really basic scenarios and how to use it on the graphic calculator. The first one, Bob is putting $2,000 away every month into an annuity that pays 7.2% per annum over a 20-year period. His tax rate is 42%, and we want to work out how much tax Bob will pay in the first year. So that's a pretty well straightforward question. The money's going to exist in the future, so therefore it's got to be a future value question. So once again, write down NI, PV, payment, future value, payments per year and compound periods per year and fill them in. So we know that. Now notice that we've got 1 times 12. Even though the whole annuity is for 20 years, we want to look at how much interest he earns in the first year. So this is a simplified way of doing it, and it still works, so we'll do it this way. So if you grab your graphic calculator, and bring it up, then you'll look at it'll look like this. And we need to put in here in the end, we'll go 1 times 12, and then we'll come down. We want to find FV, which is F5, future value. We want to find out how much it's worth in the future, and it's worth $24,808.06. Okay, so now that means that's how much money it is worth after the time. So we want to work out how much we actually have earned in interest. So we know how much is in the account, which is at 24,000, and therefore now what we're going to do is find out how much of that is interest. So the easiest way to do it is say, okay, over that whole year time, we put in $2,000 every month, so it's 12 lots of 2,000, which is in here, and if we take that away from what we actually got at the end of the year, we'll end up with how much interest. So we ended up with $808 in interest. Then coming down to here to work out how much tax we pay, if that's our income, $808.06, we times it by 0.42 because that's our tax rate as told in the question, and that means we have $399 which we have to pay in tax. So if you want to work out how much you actually really saved, you'll get your $24,808, which is what's in the account, take away your $399, which you worked out for your tax, and you end up with that much as you saved. So taxation does have a bit of an impact. In real life, when you're saving up for super and things like that, there's a lot of other tax benefits and tax breaks, but we're not going to look at that now. Let's have a look at a slightly complex one, where Bob's the same thing saving, but he wants to work out how much interest he earns between year 8 and year 9. Now it gets quite tricky to work it out by doing the other way, but there's some cool little things that the graphic calculator will do for us. So once again, we write down all these things, and you'll notice that I've got a PM1 and PM2, and I'll explain what that means in a minute. We've still got the same standard NI, PV, payment, all those kind of things. We've just got this little bit up here. And what this means is we can actually work out PM1 stands for payment 1 and payment 2. So it'll work out from payment 1, which is our 8-year mark, to payment 2, which is our 9-year mark, how much interest is earned between those two brackets there. And the calculator will do it for us without us having to take anything away or anything like that. So once again, PM1 stands for payment 1, PM2 stands for payment 2. These are our years, and it's being done monthly. Notice down here, our N is now 240 because we're looking over the whole period here. We're looking over the 20-year period, and everything else stays the same. So on the graphic calculator, you'll see that you've got this window here, which we got from that last one. Down here is an AMT button, which is amortization. So if you hit F4, you come up with this other window. And I've already done 8 lots of 12, which gives me 96. And if I go 9 lots of 12, will give me 108. So what this is going to do, this is going to work out for me between 8th year and 9th year, the amount of interest in that time period. So we're just going to change this to 12, and we're right. And if we scroll down, you'll already see that the calculator's already put in that value for FE. Now, along the bottom, you'll see there's a whole lot of different things. There's a BAL, an interest, a principal. This one here is sigma interest. What this will do, sigma interest will add up for us, this one here, which is F4, the interest between that period and that period, between PM1 and PM2. So if we go F4, it'll tell us that between those two periods, we earned $21,585 in interest. Now that might seem like a lot, but there's about $300,000 or $400,000 in the account because it's been saving up over a long period of time. So you're putting $2,000 a year and 24 grand a year is going into it. So after 8 years, you're going to have a chunk of money. So that's how much interest we earn in that period, which is a whole lot of interest. Therefore, we have to be paying tax on that. So how does that look when you actually work out the tax bit? Okay, so let's just have a look in here. We're using the amortization button on the calculator. We put in PM1, PM2. Our interest is $21,585. If you times that by 0.42, you end up with $9,066.07. So that is the amount of tax that you pay using that way. So remembering that you go to the amortization button on your calculator, enter it in, and away you go. You've really got to learn these steps because it'll help you in the future.